Welcome back. Now, that's a look at the first medium-term budget statement, or rather the second one under a coalition government, but the first full budget cycle under the GNU. Kevin Lings, Chief Economist at Stanlib, and Frank Blackmore, Lead Economist at KPMG South Africa, as well as Mpho Mlopoyane from Alex Forbes, join me to unpack the Minister's mini-budget. Gents, lady, thanks so much for your time this afternoon. First things first, let's get your initial reaction to the update. Did it meet your expectations? Some things expected, other things not so expected. Mpho, let's start with you.
Yeah, I mean, I think it was broadly in line with expectations. Very boring budget, which is great, nothing to fight over. But, the key highlight really being the endorsement of the low inflation target, alleviating that uncertainty between monetary policy and fiscal policy coordination. So great on that part and in line with expectations. I think also positively as well in this budget was the decrease in issuance. I don't think that was expected by the market, and we expect that bonds will rally on the back of that. So overall positive.
Positive, right? You mentioned a boring budget, and I think we need that after so much drama this year. Frank, let's get your take on the budget. When we started the pre-budget analysis at around 1:45, the rand was sitting at 17.15. I'm looking at it right now. It's at 17.06 to the dollar. Can we say that markets are happy about this budget?
Yes, I would agree. I don't think there's too much controversial in what was presented. Of course, the questions are what will be implemented later on. I think most of our touch points in leading up to the medium-term budget have been taken into account. Growth remains key, a key priority, of course. I think there were questions regarding collections and expenditure side. We've over-collected to budget. I think interesting things that have come into the budget are the change in procurement system, and anybody listening to the commissions and committees over the last few weeks will have seen that as a weakness in the system, with a lot of money not ending up where it should. And the launch of the procurement payments dashboard, I think, is an important step in that direction. So that caught my eye. I think the expenditure is where we should. We always knew we were going to get good updates regarding infrastructure projects, and those are ongoing and are also, making progress in those areas. So I think generally this was a good news budget. But as I said, there's a lot of work still to be done on the back of these words in order for impacts to be felt within the economy.
And just on that, then, Kevin, maybe let's look at, the upbeat revenue collections. Finance Minister Enoch Godongwana expects collections to stay buoyant on the medium term. They've collected about 1.94 trillion rands. That's up from the 1.8 trillion that was expected before. Maybe let's talk about that and how it's going to be spent, right? Treasury has promised spending restraint. Where are some of the biggest cuts or reallocations, and what might impact the kind of impact they have on, I guess, service delivery?
So I think in the short term, there is a little bit of an additional allocation, around about 15 billion. Some of that, I think, is to go to the provinces. Obviously, some of the provinces are struggling a little bit with meeting some of the expenditure requirements. Also, there's some money for the local government election next year. So there's some of those allocations. I think in the scheme of things, it's acceptable. I wouldn't be overly concerned about that. And if you think that the revenue overrun is about somewhere between 19 and 20 billion, and government's going to increase expenditure somewhere between 15 and 16 billion, you would say that kind of washes out. So those numbers are acceptable. The bigger focus is, in the speech, the minister's saying that we're going to systematically move away from consumption expenditure into infrastructure spending. And to me, that's absolutely critical. If I look at the numbers he's put down in the budget for infrastructure, it's still modest. It's not enough. it's coming off a very low base, and I think we've got to put in a bigger effort to up the infrastructure element. Obviously, he's focusing on the greater use of private-public partnerships, and I think that's exactly right. And so it's now becoming clear that those partnerships between in the energy space, in the railway area, and also in ports, that's going to play a critical role in trying to improve South Africa's infrastructure, and I think that's very welcome. So without that component, I think the focus on infrastructure would be a little bit underwhelming. So my sense is the direction of travel is right. The overall tone of this medium budget is appropriate. There are a number of positives, tangible positives that have been achieved. I think the credit rating agent, Stanlib on Friday, I think will take all of this into account. I think it's a positive set of factors, including the endorsement of the lower inflation target. So I wouldn't be surprised if we get a credit rating upgrade from S&P, and I think it's all moving in the right direction. So I would give credit where credit is due. This is positive. It'll be positive for foreign inflows into our bond market. It'll be positive for the bond market, positive for the rand, positive for equities. So there's very little to be critical of in terms of this update.
So very little to be critical about, Kevin says, and we are moving in the right direction, it seems, Mpho. Just talking about that credit rating review coming on Friday from S&P, what do you expect on that front? I mean, we're also off the grey list, so that also, you know, a bit of a boost when it comes to investor sentiment.
Yeah, I mean, the expectation really has been that the fiscal environment has improved. And this is despite the still low growth environment, right? So growth has been the key indicator that everybody has been watching, that we need to get an improvement in growth before we start to see rating upgrades. But even in that low growth environment, we've actually seen improvements in the fiscus, particularly this year with year-to-date tax revenue collections running ahead for various factors. And also just to keep in mind, if you actually look at the year-to-date tax collections, we are not even factoring in yet the positive impact that's likely to come from the rally in commodity prices that we've seen so far this year, gold and PGMs. So there's still some tailwind, certainly, in terms of the tax revenue outlook. So overall, the fiscus has improved, and this is what has created expectations that S&P could essentially lift the sovereign credit rating by one notch. And also creating this expectation is that S&P had already had the outlook for South Africa on positive already last year, right? So there's an expectation that's likely to get resolved now or by the time of the February budget. Another key consideration, some of the discussions that we've been having in the investor community, is that actually when you look at South Africa's fiscal environment and fiscal matrices, yes, there has been a deterioration over the past couple of years, but actually when you look at the forecast in terms of when South Africa was actually downgraded to sub-investment, the debt to GDP trajectory has not deteriorated to the extent that was initially feared, right? So, you know, I remember the governor saying in one of the investor meetings that, you know, surely that calls for a different discussions with rating agencies to say that, yes, there has been a deterioration, we acknowledge that, but, you know, there's been an improvement. And actually, in hindsight, if you look at where you thought the debt to GDP trajectory will land, it didn't reach that.
And just keeping that in mind, keeping that debt to GDP picture in mind, then, Frank, let's maybe touch on growth a bit further, right? So growth has been lowered for the year, but over the medium term, it still seems quite strong. Of course, infrastructure at the heart of that growth story, and Treasury announcing the launch of a new infrastructure bond to boost capital investment. Considering the current picture at the moment, at the optimism at play, will we get buy-in when it comes to that bond?
I'm sure we will get buy-in. with respect to that bond. They're looking to raise, I think, 15 billion in the first round for a number of projects. That's also facilitating the inflow of that private sector money that we so need. We need a better balance between, obviously, the state and private funding. And a lot of things are coming into play with respect to that. Also, I refer to the updating of the Triple P type of legislation at national level, and that's the municipal one will also be, the Finance Management Act will also be updated next year. According to this speech, and all of those will facilitate private sector involvement in some of these areas. So to me, that's important. I think growth is still woefully low for the problems that we have. If we want to undo kind of the employment issues we have, the poverty issues, we have to get that up. But the groundwork for that is, as you said, through revitalizing our logistics sectors, making sure the infrastructure is working properly, and allowing private sector then to leverage that infrastructure in order to create growth in the economy. So again, moving in the right direction, but we're not quite sure when this will happen. We also had optimistic views of this year's growth, but if you ask yourself what really has changed year to year that will result in a 1.8% growth over the next 3 years, we still need to do a lot of work before we see that type of growth.
You touched on those, private-public partnerships at play. And, throughout the years, we've heard from the private sector talking about how our regulation is not welcoming. With everything that's been said then, Kevin, are we moving closer to the kind of a friendlier regulation and more welcoming for private sector players?
Yes, I think we are in general, but there's a lot more that needs to be done. So take some simple things. Not that long ago, you couldn't contemplate private sector operating railway in South Africa, and now we've got 11 private sector rail operators that have been appointed to help Transnet with the improve their capacity. And that's a welcome improvement, and that's effectively a form of deregulation. We've got the Philippines company going to get involved with Pier 2 Harbour in Durban. Effectively, that's a deregulation. So there are these initiatives. We freed up the private sector to get involved in the production of energy, renewable energy projects. They've invested massively. So there's quite a lot that has occurred. But if you still look at the overall framework, we've got to do more. We've got to, at every level, we've got to free up smaller business, medium-sized business. They were massively over-regulated relative to what they can deal with. We've got to provide greater access to finance. There are a lot of initiatives that I think we could put in place. So I would say, yes, we're making progress, and we're making progress in some important areas. But I wouldn't in any way say job done. I would still consider us a highly regulated business environment relative to most other emerging markets. And I think that's not ideal if we want to create private sector investment and we want to crowd the private sector into our growth initiative.
Maybe let's dig further into that inflation target, where the Treasury has now decided to support the SARB in its move to lower the target to 3%. Now, he's mentioned that there's a 1% target band to accommodate unexpected shock. Does this mean that inflation can teeter around 4%?
Yeah, so essentially, if you think about it, Treasury would disagree with me on this. But essentially, the target has been reduced from 4.5% to 3%. And in addition to that, the band has also been narrowed as well. So 3% being the midpoint with a 2 to 4% essentially tolerance in terms of the deviations from target essentially. But I think for the importance of anchoring inflation expectations, the languaging that we are seeing from National Treasury as well as from the SARB is that they want to anchor on 3%. So moving away from 2 to 4.
Yes,
essentially.
All right. Let's get your thoughts around that inflation targeting then, Frank. The Minister, Godongwana, mentioned that there will be short-term fiscal pain as expected, right?
Absolutely. So I think just to emphasize the governor's words here is there's no more important thing to sort of safeguard the wealth and incomes of the poor in this economy as bringing down that inflation rate. So, I mean, that's the target. Of course, it also does other issues. It brings down the cost of money, and therefore we hope more people can enter and borrow in that regard as well. So I think obviously it's going to be an important new target, and like the previous adjustment from 6 to the 4.5, it will take a little while to adjust, and in that while we'll have to keep interest rates higher than they would be once we hit the 3% target. And that means people will not go to the market and perhaps borrow as much as they want. And that's the cost he's talking about there in terms of households and businesses, maybe not borrowing now, but waiting until that interest rate comes down. But I think what was important of today's announcement is the alignment of Treasury and the Reserve Bank. And hopefully that messaging will get to the people sooner. And so those expectations can be anchored at that 3% level. As soon as that happens, we'll be in the clear for the benefits of that lower target rate.
Those long-term gains, of course, will be coming through. But with that being said, then, Kevin, can we safely say that then we're likely not going to get a rate cut come November? Well, in a few weeks.
Yeah, it's a tough one. Technically there is scope to cut rates. The Reserve Bank has said that rates are slightly restrictive, and I think you could make an argument to cut 25 basis points, something like that. But I think from the Reserve Bank's perspective, they would argue that getting this inflation anchored at 3% is of primary importance, and that yes, we may experience a little bit of pain in the short term, but the longer term benefit is enormous, and I think most people would agree with that. So is there one interest rate cut we could miss out on? Possibly. I don't think it's a big deal. I think that the level of interest rates right now is not actually the key factor holding back South Africa. To me, the key factor is around regulation, around trying to get private-public partnerships going, around government, better infrastructure, service delivery. There's a whole range of other issues that I think playing a much bigger role in how this economy is performing. And I would like to see more effort on resolving those than worrying about 25 basis points. The Reserve Bank, we have to say, has done a good job. They've got a lot of credibility. I would be comfortable leaving the decision in their hands. I don't expect us to get another rate cut, but I don't think it's that problematic in the scheme of things.
And let me correct myself. That meeting is not in the next few weeks. It's actually next week, Thursday. Right. So high inequality levels, Mpho, really continue to hit the country. Yes, yesterday we saw that improved unemployment rate, but of course, looking at Q1, Q2 growth, very low, 0.1%, 0.8%. And there's been a lot of confusion around the SDR grant, and we know that millions rely on it. What's the plan there? What's the government's plan when it comes to that? Is it treating it like a permanent support measure or just a stopgate to buy time?
I mean, I think in recent years it has been used as a stopgate to buy time. I think I would, agree with those words. I mean, if we think about it, it was initially meant to be a temporary measure. When it was announced, I'm pretty sure all economists were like, there's nothing as temporary. There's never anything temporary about, government grants. And that was actually reaffirmed given how many times that was extended, right? But, I think the pressure on National Treasury to continue extending it just highlights, the plight of many South Africans and how they've come to be reliant on that COVID grant, right? But what National Treasury has communicated over the years, and hopefully they will give an update on this soon, is that they actually want to move away from people being dependent on social grants, right? So they've talked about a realignment, sort of consolidating many of the social grants that are currently being distributed. And essentially, they want to align them more towards employment programs. So hopefully we will get an update on that, because you really don't want to build a state where people are reliant on social welfare, right? But you also need to enable people to go out there, look for job opportunities, but also be able to find job opportunities when they do go out there. So hopefully we will get an update on that relatively at next year's budget, or sometime soon.
A really tough balancing act when it comes to that, Frank, and maybe, questioning the sustainability of it all, and what happens if Treasury delays a clear decision yet again.
Yeah, sure. I think South Africa is stuck between a rock and a hard place because of our history. We've always had two primary goals, basically. We've had to grow the economy on the one side, and we've had to look after the social welfare of a large portion of our population at the same time. So on the one hand, you have this long-term goal that's trying to get growth, and on the other hand, you're trying to look after people who are not integrated into the economy. But obviously, we've had, I think, a lot of policy missteps thus far, which has meant that the people benefiting from grants has sort of swelled. The economic growth hasn't been there in order to pull the unemployed into the economy and get that economic inclusion and independence. And I think, hopefully that's where we're headed. And it refers back to what Kevin said, that movement from consumption to the investment expenditure. So I think it's always, even if in sort of well-managed governments, it would be difficult to know how much money to assign to growth, how much to social development, etc. But I think what is clear, and I think Mpo stressed that, is to simplify the system, make the system more efficient, whether that means a basic income grant instead of all these different type of grants, means tested type thing, better managed. So you're lowering the sort of public cost of your grant system, but you're still affording those who need it some respite in that regard. And I think that's sort of where we are moving. We've had a lot of shocks in between with, since COVID, then the war overseas, the high inflation, and recently, I guess, the US administration's impacts on the economy, the uncertainty. So I don't think it's been the easiest time to bring in those changes, but I think that's what's on the cards over the medium term.
And maybe let's touch on the politics of it all before we close, Kevin. I know not much updates or adjustments when it comes to the mini budget, but what do you think it reflects when it comes to the dealings within the GNU? Is it a more coherent, a more harmonized approach?
I think so.
Yeah, I think so. I think it is. I think it. If you look at this update, it reflects quite a lot of the policies that the DA would have and would endorse. So I don't think there's going to be any significant disconnect within the GNU around this. And certainly the greater use of private-public partnerships, that has become an increasingly larger feature, and I think will grow. The test is going to be when we get to next year's budget, and now we are heading towards the local government elections. To what extent are we now trying to use the budget to focus on improving the local government situation, service delivery, and that is seen as electioneering? There's a risk around that. And to what extent do we continue to focus on let's build the infrastructure of this country and let's do private-public partnerships? And I think that may end up being a testing time, but I'm not expecting that you're going to see any sort of breakup of the GNU or anything like that. And this, I think this iteration of the budget framework would probably, if anything, strengthen the GNU. And I think it would send a signal that the main political parties are on the same page.
All right, let's leave it on that note. Thank you so much for your time and sharing your insights with me this afternoon. That was Kevin Lings, Chief Economist at Stanlib, Frank Blackmore, Lead Economist at KPMG, and Mpho Lopoyane, Chief Economist at Alex Forbes, with insights on the day's medium-term budget policy statement.